What's up guys, welcome back to the channel. Today we're diving into a fresh interview with 𝗗𝗟𝗏, the head of research and chief investment officer at Fundstrat. He just went on CNBC's Power Lunch and dropped some bold insights about the markets, the Fed, and where stocks could be heading next. And according to him, small caps could hit record highs next. Now that's a big statement, especially with all the uncertainty around rates, inflation, and investor sentiment. In this video, I'm going to show you the exact clip of 𝗗𝗟𝗏's interview, then break it down with my own reaction and analysis. After that, I'll walk you through my picks for the 3 best small cap stocks to buy right now, based on everything we're seeing in this market. So if you only watch one investing video today, make sure it's this one, and stick with me all the way through to the end. You don't want to miss it. And of course, hit that like button. Let's run it up to 1,000 likes. Share this video with your friends, drop your thoughts in the comments, and don't forget to subscribe so you never miss the next big financial update. Alright, let's roll the clip and hear what 𝗗𝗟𝗏 had to say.
𝗗𝗟𝗏 of Fundstrat is with us. Tom, welcome. You can comment on all those moves or anything else if you'd like, but also I want you to comment on something that hedge fund billionaire David Tepper said on Squawk Box this morning. Listen.
I don't think another ease matters, as far as being too easy. It's going to be a little bit restrictive, or even if they do two. Beyond that, it's going to be a little tricky, I think, because you got to be careful not to make things too hot, to have the other side of the mountain, which was really freaking ugly, in 2000, in 2001, etc.
All right, so let's bring in 𝗗𝗟𝗏, not the drummer. Tom, what do you make? I mean, how much does the Fed really matter to the equity markets right now?
The Fed still matters a lot because they are the most powerful institution in the world. And it matters because monetary policy relatively tight has kept the ISM below 50 for 31 months. And so corporate America has operated with a bit of caution, keeping the car in low gear because they didn't know where inflation was going to be and they didn't know where monetary policy was. So I think when the Fed begins to ease, it's not just a move in interest rates, but it's a green light for corporations to get more confident. And as you know, the ISM moving above 50 does not only revive economic activity, it probably also rejuvenates the labor market, which has been sluggish for what looks like more than 12 months.
So does that mean if the Fed stays dovish or keeps cutting, that there's other newer legs to this pretty remarkable stock rally?
Yes, and I might even say that I think that we could have growth recover without inflationary pressures. I think reflexively, people the last few years think growth picking up means there's automatic inflation. That has not been the case for 25 years. But I think if companies begin to expand, plus the fact that we know AI is driving productivity gains, and that's really a big tailwind for businesses, and then we know that there's initiatives around Wall Street boosting productivity because they're going to build on the blockchain, I think there's a path for growth to be stronger next year without a pickup in inflation. That's going to be very good for profits and for equities.
Yeah, and listen, we've talked about many times, Tom, and I know you've talked about Scott and others as well. You've been long, you've been strong, you've been correct. But is there, at some point, does this market take a breather? It's getting, listen, as a 401k holder, I like it. But as a TV analyst who's been doing this for almost 30 years, I'm starting to worry about it a little bit.
Yes, I mean, a pullback is going to be inevitable. But from a timing perspective, sentiment still remains staunchly negative. So, I think the gold standard is the AAII net bulls, less bears. That's been 6 consecutive weeks where it's negative. That's never really marked a market top. I mean, that has to flip positive and sustain for several weeks. So I think if we're going to say between now and year end, could the market pull back? I'd say it's possible, but to me, it's probably from higher levels. I think there was a lot of skepticism about even yesterday's FOMC. I had a lot of clients tell us they thought the stock market would sell off because 25 was priced in. But because almost everyone told me that was the consensus view, I think people were cautious into yesterday. And that's why we're seeing the groups that should rally big, like the small caps and the cryptos and the financials and even the Mag 7.
We might even get a record high for the Russell 2000 about 75, 80 minutes left to go. We'll see what happens. 𝗗𝗟𝗏, we're going to let you go, but always appreciate you coming on, Tom. Thank you.
So first, 𝗗𝗟𝗏 was asked about David Tepper's comments. Tepper basically warned that the Fed needs to be careful with easing. If they cut rates too aggressively, it could overheat the economy and create the same kind of crash we saw in the early 2000s. Now, Tom Lee's take is really interesting here. He says the Fed still matters a lot because, at the end of the day, they're the most powerful institution in the world when it comes to financial markets. Tom points out that monetary policy has been tight for a long time, 31 months with the ISM Manufacturing Index stuck below 50. For those of you who don't follow ISM closely, below 50 basically signals contraction in the economy. That means businesses have been cautious, keeping things in low gear, as Tom puts it, because they didn't know where inflation or Fed policy was going. So what happens if the Fed starts easing? According to Tom Lee, it's not just about interest rates dropping, it's about confidence. A Fed rate cut is like a green light for corporate America to take their foot off the brake and start investing and expanding again. And when ISM climbs above 50, that not only signals stronger economic activity, but it can also rejuvenate the labor market, which he says has been pretty sluggish for over a year. Now, the next big point Tom makes is crucial. He says growth doesn't automatically mean higher inflation. That's a mindset a lot of investors have carried over from the last few years, but he reminds us that for the past 25 years, economic growth has not always equaled runaway inflation. He even goes further. With AI driving massive productivity gains and Wall Street adopting new technologies like blockchain to boost efficiency, businesses might actually be able to grow faster without sparking inflation. That's a huge deal because it means the economy can accelerate, companies can make more profit, and stocks can keep climbing, all without the Fed panicking about inflation overheating. Then the host pressed him. Is the market getting too hot right now? Should we worry about a pullback? And Tom acknowledges yes, pullbacks are inevitable. But here's where his reasoning stands out. He says sentiment is still very negative. The bulls minus bears indicator has been negative for 6 straight weeks. Historically, that doesn't happen at market tops. For a real top to form, sentiment usually has to flip positive and stay there for weeks. In other words, despite markets rallying, investors are still skeptical. And that skepticism is actually fuel for more upside. He also notes that a lot of investors thought the market would sell off after the Fed's most recent 25 basis point cut, because that move was already priced in. But because almost everyone thought that way, people stayed cautious. And that caution is exactly why we're seeing the groups that were under pressure, like small caps, cryptos, financials, and even the big tech names, rally hard now. Tom even points out that we might see the Russell 2000, which tracks small cap stocks, hit record highs sooner than people expect. That's another sign that this rally isn't just about the Magnificent Seven anymore, it's broadening out, which is a very healthy sign for the market. So, to sum it up, Tom Lee believes the Fed's easing cycle is more than just a rate cut. It's a green light for corporate confidence. He sees growth coming back without the inflation scare, thanks in part to AI and productivity gains. He does expect some pullbacks along the way, but overall, sentiment still looks too bearish for this to be the end of the rally. And he's pointing to areas like small caps and financials as sectors that could benefit the most from here. If you're an investor, this is a reminder that while short-term pullbacks will happen, the bigger trend could still be higher. The key is not to get shaken out by the noise. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the 3 best small cap stocks to buy now, with the potential to hit record highs in this recent market rally. First up is Bath & Body Works, ticker BBWI, a brand you probably know, but the story has changed dramatically in recent years. Once seen as just another mall retailer, Bath & Body Works has quietly transformed itself into a powerhouse in the personal care and fragrance space, and the market is only starting to catch on. For years, Bath & Body Works was tied to Victoria's Secret under the L Brands umbrella. But in 2021, BBWI spun off, finally shedding its struggling sibling and unlocking its true potential. This move allowed Bath & Body Works to focus on what it does best, delivering high-quality, affordable luxuries that customers love, without being weighed down by the challenges facing Victoria's Secret. Now, Bath & Body Works is a focused, high-margin business with a fiercely loyal customer base. The company has streamlined its operations, making them leaner and more efficient, and has doubled down on the in-store experience that keeps shoppers coming back. Their stores are vibrant, inviting, and designed to encourage exploration and repeat visits. Since the spin-off, BBWI has ramped up its direct-to-consumer business, investing heavily in e-commerce and digital marketing. The company has optimized its store footprint, closing underperforming locations and enhancing top-performing ones. As a result, Bath & Body Works has generated strong free cash flow, giving it the flexibility to invest in growth and return capital to shareholders. That cash is going straight to shareholders. Think aggressive share buybacks and a dividend yield that's now over 4%. In a market where income is hard to find, BBWI stands out as a company that not only grows but also pays you to own it. You're getting paid to wait for growth, and management is clearly committed to rewarding investors. Their capital allocation strategy is disciplined, prioritizing sustainable dividends and opportunistic buybacks, all while maintaining a healthy balance sheet. But this isn't just a dividend play. Bath & Body Works is innovating at a rapid pace, rolling out new products and seasonal collections that keep customers engaged year-round. The company is also expanding internationally, tapping into a massive global market where demand for affordable luxury is on the rise. From North America to Asia and beyond, BBWI is planting its flag in new territories and building a global brand. Their brand loyalty is a true moat. Customers return again and again for their favorite scents, and the company's robust loyalty program encourages even more frequent visits. This creates a powerful engine of recurring revenue, with a customer base that's both passionate and sticky. Despite all these strengths, the market has punished the stock over broad retail fears. Concerns about consumer spending, inflation, and the so-called death of the mall have weighed on BBWI's share price. But here's the thing, Bath & Body Works' fundamentals remain strong, and the company is proving it can thrive even in a challenging environment. Right now, BBWI is trading at a value price despite its profitability and growth prospects. For investors willing to look past the headlines, there's a real opportunity here to buy a quality business at a discount. This is a classic value play, a market leader, post-turnaround with a clear growth path and shareholder-friendly policies. The company has already proven it can adapt and win, and now it's positioned to capture even more market share as the retail landscape evolves. Management is fully aligned with investors, with significant insider ownership and recent insider buying signaling confidence in the company's future. This kind of alignment is rare and speaks volumes about the leadership's belief in the business. Of course, there are risks. The biggest is a slowdown in consumer spending, especially if the economy takes a turn for the worse. But history shows that affordable luxuries like Bath & Body Works products tend to hold up even in tough times. When people cut back, they still want small indulgences, and BBWI delivers just that. As inflation cools and consumer confidence returns, Bath & Body Works is perfectly positioned to benefit. The company's value proposition becomes even more attractive as shoppers look for quality and affordability. The market still sees Bath & Body Works as a struggling mall retailer, but the reality is very different. It's now a cash-generating machine with robust free cash flow supporting both growth initiatives and shareholder returns. The turnaround is real, and the foundation is solid. Bath & Body Works has rebuilt itself from the ground up, emerging stronger, more focused, and ready for the next phase of growth. For patient investors, the risk-reward profile here is incredibly compelling. You get a market leader with a proven track record, strong cash flow, and multiple levers for future growth, all at a price that doesn't reflect the company's true potential. That's why BBWI is my first pick, a small-cap gem that's been overlooked by the market but not for long. As the story gets out, I expect more investors to take notice. With Bath & Body Works, you get value, income, and growth potential all in one package. It's rare to find a company that checks all three boxes, but BBWI does just that. So keep Bath & Body Works on your watch list. This is a story of reinvention, resilience, and real opportunity, and it's just getting started. Next up is 𝗗𝗓𝗏 Realty Trust, ticker symbol AKR, a real estate investment trust that's carved out a unique niche in the world of high-end retail. Unlike many REITs that spread their bets across malls or suburban shopping centers, 𝗗𝗓𝗏 is laser-focused on owning and operating some of the most coveted retail properties in the wealthiest urban markets across the United States. Their portfolio is a who's who of luxury shopping destinations, and their properties are found in the heart of cities where affluence, tourism, and global brand power converge. 𝗗𝗓𝗏's real estate holdings include prime addresses on legendary shopping streets. Think Madison Avenue in New York, the bustling boutiques of Soho, and other iconic retail corridors. These are the places where luxury brands like Gucci, Apple, Cartier, and Louis Vuitton compete for flagship space, and where the world's most discerning shoppers come to experience the best in retail. For these brands, having a physical presence in these locations isn't just about sales. It's about prestige, visibility, and cementing their status at the top of the luxury pyramid. 𝗗𝗓𝗏's strategy is simple but powerful. Focus on locations with extremely high barriers to entry. In these neighborhoods, new development is tightly restricted, zoning is complex, and available space is scarce. This creates a formidable economic moat, one that protects Acadia from competition and ensures that their properties remain in high demand year after year. These trophy assets give Acadia a level of pricing power that most landlords can only dream of. Even when other retail landlords are struggling with vacancies and falling rents, Acadia's properties are bustling with activity. Their locations are magnets for both global tourists and local elites, ensuring high occupancy rates and a steady stream of rental income. The retail is dead narrative simply doesn't apply here. For luxury brands, a physical flagship store is a critical part of their identity. It's where they launch new collections, host exclusive events, and create immersive experiences that can't be replicated online. These stores are showrooms, status symbols, and marketing engines all rolled into one. That's why demand for Acadia's properties remains robust, even as e-commerce disrupts other corners of the retail world. In fact, demand for Acadia's properties is stronger than ever. The company is reporting record-high rents and near-full occupancy across its portfolio. As luxury brands expand and new entrants seek a foothold in top-tier markets, competition for space is fierce. This allows Acadia to push rents higher and lock in long-term leases with some of the most creditworthy tenants in the world. As a REIT, Acadia is required to pay out most of its income as dividends, making it an attractive option for income-focused investors. But what really sets Acadia apart is its dual growth engine. On one side, you have a stable core portfolio of irreplaceable properties that generate consistent cash flow. On the other, Acadia operates a fund business that opportunistically acquires, redevelops, and sells properties, unlocking value and recycling capital into new opportunities. This flywheel effect allows Acadia to grow both its income and its asset base over time. Despite being lumped in with struggling retail REITs by the broader market, Acadia's fundamentals are rock solid. The company is consistently growing its funds from operations, a key measure of REIT profitability, while maintaining a conservative balance sheet and prudent leverage. Their management team has a proven track record of navigating both booms and downturns, and they're laser-focused on long-term value creation. Acadia's tenants are a who's who of blue-chip brands, names that are synonymous with quality, stability, and global appeal. These tenants provide secure, predictable cash flow, and their long-term leases help insulate Acadia from short-term market volatility. When you walk past an Acadia property, you're likely to see the logos of the world's most valuable brands, each one contributing to a steady stream of rental income. Of course, no investment is without risk. Rising interest rates have put pressure on REITs across the board, as higher borrowing costs can eat into profits and weigh on share prices. But as rates peak and potentially begin to fall, this headwind could quickly turn into a tailwind for Acadia, unlocking value for patient investors. The real catalyst for Acadia, though, is continued strong leasing activity, high occupancy, and growing funds from operations. As the market starts to recognize the company's unique position, owning the best retail real estate in the country, with a fortress balance sheet and a growth engine under the hood, there's significant potential for a re-rating of the stock. The biggest risk on the horizon is a severe recession, which could impact even the wealthiest consumers. But Acadia's focus on affluent demographics and prime, irreplaceable locations offers a level of resilience that's hard to match. Even in tough times, luxury brands are less likely to close flagship stores in top markets, and high-net-worth shoppers tend to be more insulated from economic shocks. That's why Acadia stands out as a defensive investment with real upside potential. It's a smart way to play the evolution of retail, focusing on the segments that are thriving, not declining. For investors looking for a blend of stability, income, and growth, Acadia offers a compelling proposition. If you're searching for a small-cap REIT with a strong competitive moat, reliable income, and a clear path to growth, AKR deserves a spot on your watch list. The combination of trophy assets, blue-chip tenants, and a savvy management team makes this a rare find in today's market. In short, Acadia is the landlord to the world's best brands, and right now, the market is offering a rare entry point for investors who recognize the enduring value of prime real estate. If you believe in the future of luxury retail and want exposure to some of the most desirable properties in America, Acadia Realty Trust is a name you shouldn't overlook. Finally, let's talk tech. GitLab, ticker GTLB, a true disruptor in the world of software development. In an industry where innovation is the name of the game, GitLab has emerged as a company that's not just keeping up, but actively shaping the future of how software is built, tested, and delivered. If you've ever wondered what the next big leap in software tools looks like, GitLab is a name you need to know. At its core, GitLab offers a unified DevOps platform, a single integrated solution that streamlines the entire software lifecycle from the very first idea to the final deployment. This means that planning, coding, testing, security, and deployment all happen in one place, eliminating the friction and delays that come from switching between different tools and platforms. Instead of juggling a patchwork of disconnected tools, development teams can use GitLab for everything. This all-in-one approach doesn't just boost efficiency and speed, it also reduces errors, improves collaboration, and makes it easier for teams to innovate together. The result? Faster releases, higher quality code, and happier teams. Today, every industry is becoming a software industry. From finance to healthcare, retail to manufacturing, companies everywhere are racing to build better digital experiences. That's why GitLab's addressable market is not just massive, it's expanding at a breakneck pace, as more organizations realize that software is at the heart of their competitive edge. One of GitLab's most powerful advantages is its open core model. By offering a robust free version, GitLab attracts a global community of developers and companies. As these users grow and their needs become more complex, many upgrade to paid enterprise tiers, unlocking advanced features and support. This model not only builds loyalty but also creates a vibrant ecosystem of contributors and advocates. This land and expand strategy is a proven engine for rapid high-margin growth. GitLab lands new users with its free offering, then expands its footprint within organizations as teams adopt more features and scale up their usage. It's a virtuous cycle that drives both user growth and revenue. The results speak for themselves. GitLab's revenue is growing at an impressive rate, and the company is steadily moving toward profitability, a rare feat among high-growth tech companies. Their disciplined approach to growth, combined with a focus on operational efficiency, sets them apart in a crowded field. Of course, the journey hasn't been without bumps. Since its IPO, GitLab's stock has seen its share of volatility, reflecting the broader ups and downs of the tech sector. But for long-term investors, this volatility has created a more reasonable entry point, an opportunity to invest in a company with strong fundamentals and a clear path to growth. What truly sets GitLab apart is its all-in-one platform. While most competitors offer point solutions, tools that solve just one part of the software development puzzle, GitLab brings everything together under one roof. This integration is a game-changer for organizations looking to simplify their tech stack and accelerate innovation. Once a company integrates GitLab into its workflow, switching to another platform becomes a major undertaking. The result? Exceptionally high customer retention, and a product that becomes deeply embedded in the daily operations of its users. This stickiness is a powerful moat against competitors. But GitLab isn't resting on its laurels. Its open-source community is a constant source of innovation, driving new features and capabilities, especially in cutting-edge areas like artificial intelligence and cybersecurity. This collaborative approach ensures that GitLab stays ahead of the curve and adapts quickly to new challenges. The company is now integrating AI directly into its platform, helping developers write better code faster. These AI-powered tools can automate repetitive tasks, catch bugs before they become problems, and even suggest improvements, delivering a real productivity boost that's hard to match. Of course, there are risks. The tech landscape moves at lightning speed, and competition is fierce. Market sentiment can shift quickly, especially for growth stocks that are sensitive to changes in interest rates and macroeconomic trends. Investors need to be prepared for volatility along the way. But for those willing to take the long view, the potential upside is enormous. As more companies embrace digital transformation and seek out integrated solutions, GitLab is uniquely positioned to capture a growing share of a multi-billion-dollar market. GitLab is a category-defining company with a massive market opportunity, a brilliant business model, and a proven track record of execution. Their relentless focus on innovation, customer success, and operational excellence makes them a standout in the software world. The shift to all-in-one DevOps platforms is just beginning. As organizations look to simplify their workflows and accelerate their digital journeys, GitLab is poised to become the backbone of modern software development. That's why GTLB is my third pick, a bold bet on the future of software and a company that's redefining what's possible in the digital age. There you have it, 3 small-cap stocks ready to soar: Bath & Body Works, Acadia Realty Trust, and GitLab. Each offers unique upside, but all share strong fundamentals and growth potential. Want to level up your investing? Check out my Value Stocks Investing Master Course, link in the description. For exclusive stock tips and in-depth analysis, join the Stocks Galore Patreon community. Details below. Now, which of these 3 stocks excites you most? Let me know in the comments. Like, share, and subscribe for more investing insights. Thanks for watching, and I'll see you in the next one.